Good evening. Hello. Good evening. Guys are Harish. Your class. So I will clarity. Voice issue. Now clear. Ganesh, now okay. My voice is it clear? Clear, Ganesh? Is it clear? Yeah, Ganesh. I will explain at the time of MTV explanation. I not get the point exactly what you explaining. And Harish, for you, this attempt maybe the chance of chapter 4, chapter 4 and mergers and chapter 8 mergers and acquisition. This is the two chapters carry more marks. Next, okay. It come to our next chapter, chapter number 6. Chapter number 6. Business valuation, methods and approaches. In exam point of view, on average, you will get 14 marks from this chapter, 2 7-mark questions mandatorily. So you'll get 2 7-mark questions, 2 problems. Next, for getting these 14 marks, we need to learn more methods here. First, method number 1, discounted cash flow method. Earning capitalization method. Yes, Gopika. Here we will discuss workbook questions. Next, company comparable multiple method. Wait a minute. For company comparable multiples. Market price method. After market price method, company comparable multiples method. Next, company comparable transaction method. After that, replacement cost method. Reproduction cost method. Net assets value method. Economic value method. Market value method. So these are the methods we have, guys. These are the methods we have for purpose of valuation. Okay, so you already know the basic version. Methods are classified from approaches. These two methods classified from income approach. These three methods are classified from market approach. These two methods are classified from cost approach. Okay, so only these methods are classified from the approaches. These three methods are not related to approaches, guys. These three methods are not related to approaches. They are direct methods. They are what methods? Direct methods. So in these direct methods, this economic value added and market value methods we are not discussing here. Why? Because the same methods and same problems given in two chapters. One is approaches, methods and approaches. Another one is assets and valuation, liability valuation. That's why I sent all economic value added problems into from chapter 6 to chapter 7, assets and liability valuation. So this economic value added concept and market value added concept we will discuss in assets and liability valuation. Hope you guys clear. Remaining all methods we will discuss here. Another disclaimer. So there is a no problems are relating to replacement cost method and reproduction cost method in approaches, but one problem is there. That problem in asset valuation, that to plant and machinery point of view. At the time of concept of valuation of plant and machinery, I will explain this replacement cost method problem. Apart from that one problem, there is no problems are relating to this replacement cost method and reproduction cost method. Now when it come to what are the problems we will discuss and what are the concept we will discuss in this chapter of in this revision class means, I will discuss about discounted cash flow method, earning capitalization method, market price method, and company comparable multiples method and company comparable transaction method. Trust me, there is a chance when it come to this chapter, it is the highly chances for getting a question. This is the area highly chances for getting a question. After that, this is the highly chances for getting a question. Net assets valuation method. Net assets valuation method. Okay. Now, without late, I start with the discounted cash flow method. Yeah. So you can observe this discounted cash flow method. So discounted cash flow method focusing only two things. One is return and another one is risk. So one is return, another one is risk. So conversion of future economic benefit into present value. Conversion of conversion of future economic benefit into present value. That is the soul of the discounted cash flow method. So in this method, we are following only blind rule. They will give future economic benefits. We are converting that future economic benefits into present value. By using that present value, we are doing a valuation. That is the concept of discounted cash flow method. For doing that process, you have to learn 5 steps. Step 1. Step 1. You have to calculate estimation of free cash flows. That is nothing but CFAT, FCFE and FCFF. So the word CFAT means cash flows after tax. Next, FCFE means cash flows, free cash flows of equity firm. FCFF means free cash flows of firm. So the difference is equity means 100% equity raised company is known as a equity firm. So that is on that company point of view, what are the cash flows you are find outing, that cash flows is known as FCFE. So if company having a debt plus equity capital, if you figure outing cash flows of that company, that is called FCFF. That is called FCFF. This is called FCFE. So CFA is also you know already. So in CMA enter FM capital budgeting decision. Under capital budgeting decision, what are the point you learned? Calculation of operating cash inflow. That is nothing but CFAT. Guys, clear? Done. So first, let us check how to find out CFAT and FCFF and FCFE. So now see calculation of cash flows after tax. Cash flows after tax. So basic thing you already know. What's the basic thing? The basic thing is so accounting principles is different. Cash is different. Why? Because in accounting principles they are following received and receivable, paid and payable. In cash concept point of view, you have to consider only received and paid. So if any receivable and payable are adjusted in net profit, you have to readjust that, you will get a cash if they provide accounting information. So if they directly give a cash information, no issue, we will consider that, we will do problem. If they not give a cash information directly, if they provide accounting information, you have to convert that accounting information to cash information. It is the time to explain conversion of cash information, accounting information to cash information. Let us check sales. It is an accounting concept. Less variable cost, you will get a contribution. Less fixed cost, it relating to operation, you will get EBITDA. So there is a explanation in financing decision and investment decision. In financing decision, so this outcome is known as EBIT. When it come to investment decision, this outcome is called EBITDA. Why? Because at the time of finance, we are not purchasing any asset. That's why we are not reducing depreciation. That's why our outcome is get EBIT. At the time of investments, we are not focusing on the interest point. That's why we're ignoring in investment decision. So here is outcome is called EBITDA. But in some cases they will give EBIT. So if they give EBIT, you have to convert into EBITDA or cash flow. That kind of explanation I will give at the end. See, so this outcome is not EBITDA. Okay. After EBITDA, you have to reduce depreciation for the purpose of tax advantage. After reducing depreciation, you will get a taxable profit called EBT. So after paying the tax, the outcome name is called EAT. This is also being known as PAT, profit after tax, is also being known as net profit. So this net profit is a accounting profit. This accounting profit includes and excludes non-cash expenses, non-operating expenses, non-cash incomes, cash incomes, non-operating incomes. These four things are not adjustable. If any already adjusted, you have to readjust. So depreciation is a non-cash expenses. We already excluded. So this is a non-cash expenses. We have to readjust. So already I deducted for the purpose of tax advantage. Now I am adding again for the purpose of cash conversion. If I add depreciation, I will get CFAT. So this is a way to calculate CFAT. Hope you guys clear about CFAT calculation. If you have any doubts regarding CFAT calculation, ask me. I hope all of you clear. Next, when it come to next concept, estimation of FCFF and FCFE. Estimation of FCFF and FCFE. Free cash flows of firm, free cash flows of equity. Now let us check this diagrammatical representation. You will get a more clarity. Okay, so the procedure is accounting profit, CFAT, FCFF, FCFE. Hope you guys clear. Now, for example, they provide CFAT information. They provide, just focus on the red colors. If they provide CFAT information, so CFAT is already cash, but on that cash you have to adjust some expenses. On CFAT, first you have to deduct capex. The word capex is nothing but capital expenditure. When it is, if they provide CFAT information in the question, so if CFAT is given, you have to reduce capital expenditure. After reducing the capital expenditure, the outcome name is called FCFF. The outcome name is called FCFF. Okay, but they're not expecting FCFF. If they're expecting FCFE, what I have to do means, I have to do again two adjustments is there. You need to reduce a debenture holder settlement. So the FCFF means cash availability in the hands of company for settlement of debenture holder and equity shareholder. First we have to settle to equity shareholders. That's why first you have to settle interest payment on that FCFF. That is net of interest. So we have a tax advantage in interest, right? So interest 1 minus tax. After that you have to take net borrowings. The word net borrowings means any repayments or new proceeds of debentures is there. If it is a positive, add. If it is a negative, reduce. So add or less net borrowings. Add or less net borrowings. After adjusting these two, you will get an outcome name called FCFE. FCFE. So this is the clarity point. If they provide CFAT information in the question, they're expecting FCFF and FCFE in the answer. So this is the way to calculate. Okay, sir, if they provides EBAT information, if they provides EBAT information, if they provides EAT information, if they provides sales information, if they provides EBT information, if they provides that kind of information, you have to check these three conditions. You have to check these three conditions. What are the three conditions, guys? The first condition is given profit is operating profit or not. If it is an operating profit, continue with the procedure. If it is not an operating profit, convert given profit into operating profit. So yes, the first take here EBAT. The operating profit is also be known as business profit, is also be known as organization profit. That is nothing but EBAT. Yes, given information is an operating profit. Condition number 1 satisfied. Next, that profit is the after tax profit or before tax profit. If it is a before tax profit, reduce the tax. If it is an after tax, yes, continue. So EBAT is not a after tax profit. That's why you have to reduce the tax. So that's why into 1 minus tax. Guys, clear? Next, you have to consider that adjusted profit is a cash profit or not. That adjusted profit is a cash profit is not. Why? Because at the time of EBAT, you already adjusted depreciation and non-cash expenses, non-operating expenses, non-cash incomes, non-operating incomes, you have to readjust. You have to readjust. Then only that profit is converted into CFAT. Let's check here. So add depreciation and amortization expenses because they are non-cash expenses. If already deducted, add back. As well as changes in working capital. Changes in working capital. If current asset is increases, increases, you have to reduce. If current asset is decreases, you have to add. If current liability increases, you have to add. Current liability decreases, you have to reduce. So this is the part of working capital changes. I'm not explaining why this, why, because it's a lengthy concept. After that, if working capital increases or they provide positive, add. Working capital decreases or negative income, less. So this is the adjustments. So EBAT, operating profit after tax, yes, it is an after tax. Add back depreciation and amortization expenses, non-cash is converted into cash. Add off working capital changes, that also be a non-cash element, that converted into EBAT, given EBAT converted into capital expenditure. Sorry, CFAT. After CFAT, you know what is the procedure: minus capex, FCFF, minus interest 1 minus tax, plus or minus net borrowings, you will get FCFE. Okay, done. Let us check here newly if question specifies profit after tax. If question specifies profit after tax. So first, operating profit or not. PAT is not a operating profit. Please convert it. How we get a PAT? EBAT is the operating profit, right? On that EBAT, they reduced interest. EBT get, they reduced tax. EAT get. So you have to readjust up again. You have to add to tax to PAT. You will get PBT. Add of interest. You will get EBAT. Let us check here. PAT plus interest 1 minus tax. Plus interest 1 minus tax. Now this PAT is converted into EBAT. Condition 1 satisfied. Condition 2, after tax or not? Yes, interest 1 minus tax is an after tax. That's why condition number 2 also satisfied. But that PAT plus interest 1 minus tax is not a cash element. That's why you have to readjust, add depreciation and amortization expenses, and increase or decrease working capital changes. So after doing all this, you will get a CFAT, less capex, you will get a FCFF, less interest and add net borrowings, you will get FCFE. So if you know this flow chart, then only you can solve discounted cash flow method problems. So newly our ICMA issued a workbook. On that workbook also they're mainly focusing on this FCFF and FCFE only. Hope you guys clear. If you have any doubts, ask me. So if you not understand this concept, you automatically confuse in problems point of view. Please respond. Gopika, Ganesh. Yeah, I got it, Ganesh. So interest also our outflow. Why we are not deducting while calculating CFAT? Yes, you can observe FCFE is a word cash flows of a firm. The word of FCFF means cash availability in the hands of company for settlement of debenture holder and equity shareholder. That's why we are not deducting before after CFAT or before CFAT. We are deducting at the time of cash in the hand of the company. Where in FCFF. That's why we are reducing interest 1 minus tax and the net borrowings here. Hope you guys, Ganesh, you got that point? Yes, it is an deductible expenditure before, but as per procedure, Company have a cash, they will settle. Company have a cash at the time of FCFF. That's why they're settled after FCFF get. Okay, Ganesh. Any other doubts? Okay. Okay. Without late, I will start next concept. Yeah. Step 1 completed. When it come to step 2, Ganesh, are you got the clarity or not? Good, good man. So step 1 completed. Next step 2, estimation of forecasted cash flows. So for this estimation of forecasted cash flows, we have to discuss four examples. So you will get more clarity. You can observe. So cash flows, we have a one-time cash inflows, multiple time cash inflows, and indefinite life cash inflows. So if I invest 1 lakh rupees in a business, there is a chance of getting a back of return cash one time or multiple times or indefinite life. For example, I invested in one plant and machinery 1 lakh rupees. After 2 years, I will receive 2 lakh 20,000. So if I invest 1 lakh rupees, for 2 years, I'm not receiving anything. For 2 years, I'm not receiving anything. But at the end of the second year, I will receive 2 lakh 20,000 for the investment of 1 lakh. That kind of cash flows is known as a single time cash inflows. Single time cash inflows. Next, multiple. It means more than one time. If I invest 1 lakh rupees, I will receive 10,000 or 50,000, 10,000, 25,000, 25,000. So you can observe, I invested 1 lakh rupees today. At the end of the first year, I received 10,000. At the end of the second year, I received 40,000. At the end of the fourth year, I received 50,000. So if that kind of inflows you have, that is called multiple time. That is called multiple time. If every year you will receive same amount, that is called multiple same cash inflows. Multiple time same cash inflows. If you receive uneven amounts, first year 10,000, second year 40, third year 40,000. So that kind of cash inflows is known as more than one, because of more than one multiple, because of not even, that is all multiple uneven cash inflows. Multiple uneven cash inflows. In indefinite life also same. So in the indefinite life means perpetual life or infinity life. If I invest 1 lakh rupees, if I invest 1 lakh rupees in a irredeemable debenture, if you already you learned in chapter 5, the irredeemable debentures means you will not receive capital at the end of the year, you will receive interest perpetual life, perpetual life. That kind of cash flows is known as indefinite life cash inflows. That indefinite cash inflows also you will receive with growth or without growth, with growth or without growth. So let us check the calculation part. So if it is a single time is given, go with the present value factor and the cash flow, you will get a present value. So if they provides multiple times same amount, same amount. So 1 to 5 years, the same amount is known as annuity. Because of annuity, we are using annuity factor instead of present value factor. If it is a 1 year, we are using present value factor. If it is the same amount and the same intervals, it is concept name called annuity. We are using annuity factor. So annuity factor of present value into annuity, you will get a present value. This is called value or valuation. So this is called value or valuation. Okay. Next, multiple uneven cash inflow. So because of multiple uneven cash inflow, we can't use the word called annuity. That's why you have to consider every year factor value. Every year value and every year factor value. If you multiply, you will get a present value. Sum of present value is known as a value. Next, example for important, estimation of terminal value. Estimation of terminal value, that too without growth. Every year you will receive same amount for perpetual life. So simple, value, terminal value equals to FCFF divided by R, divided by R. That is called required rate of return. So next, terminal value, if there is a growth. So if they are asked in FCFF point of view, you have to consider R. If they consider FCFE point of view, also R. But therefore R equals to KE, R equals to KO. That is the points you have to understand. So why? Because from, if it is a 100% equity, K is nothing but KO. If it is a debt plus equity firm, K is different, KO is different. For the purpose of valuation, FCFF point of view, you have to consider KO. If it is an FCFE point of view, you have to consider KE. Okay. Now that is a without growth concept. But when coming to with growth concept, value equals to value of firm. If it is a debt plus equity firm, FCFF1 divided by R minus G. So you already learned KE with growth, D1 divided by P naught plus G. So if you want a P naught, D1 divided by KE minus G, right? The same formula reflecting here. Instead of dividend, we are using cash flow. Instead of market price, we are using value. We are using value, terminal value. Same formula. So here also R equals to KOY because we are using FCFF. So value of the firm, FCFE divided by R minus G. Here R equals to KE. R equals to KE. Okay, done. So if you know this, you can easily answer. Come to illustration number 1, guys. Come to illustration number 1, speed up. So you can observe, you are a manager of Fasico Industry Limited. One of the projects you are considering the acquisition of Reliable Industry Limited. So owners of Reliable company is willing to consider selling his company to F industry only if he offered the all cash purchase price of 50 lakhs. So the selling company, yeah, Sujit, hi, I'm waiting for you. So when it come to selling company saying that I will sold my company of rupees 50 lakhs. Guys, clear? The project estimates that the purchase of year 1, year 2, year 3, year 4, year 5. So selling company saying that if you purchase my company will generate first year 10 lakh rupees, second year 15 lakh rupees of cash, third year 20 lakh rupees of cash, fourth year 25 lakh rupees of cash, and fifth year 30 lakh rupees of cash. If you purchase my company with 50 lakhs, this is the cash flows my company generates. Now, if you decide to go ahead with this acquisition, it will be funded with the F Limited stand mix of the debt and equity at the firm's weighted average cost of capital 9%. So KY equals to 9%. So Fasico tax rate is 30%. Should you recommend acquiring Reliable Industry to your CEO? So they're asking you, so are you recommend this acquisition to your CEO? So as a cost and finance accountant, you have to calculate this benefit. You have to compare that benefit with cost. You have to compare that benefit with the cost. You automatically say decision. If it is a benefit is more than the cost, the purchase is best one. If benefit is less than the cost, purchase is not good one. Okay, but so you can directly add this. You can directly add 10 lakh plus 15 lakh plus 20 lakh plus 25 lakh plus 30 lakh 100 lakhs. So if the benefit is 100 lakhs, cost is 50 lakhs. So if you compare 150, it is a wrong method. It is a wrong way of decision making. So why it is a wrong way of decision making means there is a concept name called time value of money. So the time value of money concept saying that today rupee is not same as a future rupee. This 100 lakh is a future value, this 50 lakh is a present value. So present value, future value, we can't take a proper decision. So that's why we are converting this future value to present value. Now we can take a decision comparison between present value and future present value. Comparison between present value and present value. So this is the method under discounting cash flow method. So as per discounting cash flow method, step 1, estimation of cash flow. They're directly given cash flow. Step 1 already completed. Step 2, estimation of forecasted. It means how many years you will receive. Yes, I will receive 5 years, 10 lakh, 15 lakh, 20 lakh, 25 lakh, 30 lakh. So step forecasting cash inflows calculation also completed. Step 3, estimation of terminal cash inflow. So in this entire problem, they are not discussing about the perpetual life. They are not discussing about the infinity life. They are only discussing about 5 years of benefit. That's why there is a no step 3. So next step 4, conversion of present value into conversion future value into present value. How? With help of present value factor at the rate of 9%. So at the rate of 9%, you will get a present value factors. If you multiply, you will get a present value. So step 5, take a decision. So present value summation is nothing but value. So how to calculate present value? So there is a trick in the calculator. I think everyone knows this. If you don't know, learn now. Take 1 divided by 1 plus r. The r is nothing but 9%. R is nothing but 9%. 1, take 1 divided by 1 plus r means 1.09. 1.09. If you press equal to, you will get a first year. That is nothing but present value factor 0.917. If you press equal to second time, it is a second year factor 842. 0.772. 0.708. 0.64. 659. 659. So this is the present value factor. If you multiply with cash flows, you will get a present value. So here lot of students are confusing. Sir, in some problems they're taken after 0.4 values. Some problems they consider 3 values. So in our new material, they're focusing on 3 values only, guys. 3 values. So if they provide in the question values, take that values. If they not provide, go with the 3 values. After decimal, you have to consider 3 values. That's it, guys. So if you do like this, you will get a 74,45,175 rupees. 74,45,175 rupees. I calculated. I am suggesting to CEO, sir, sir, if you purchase that company, we will get net benefit 24,45,175. Why? Because the benefit they received is higher than the cost we are investing. We are investing only 50 lakhs. We are receiving 74 lakh. It is a beneficial. Go ahead and purchase, please. So this is the decision. So students, only calculating the answer, there stop the explanation. So at the end of the point, you have to write the comment also. For that comment, you are receiving 2 marks. For comment, you will receive 2 marks. So if you not write that comment, what they're asking, so you will lose 2 marks. You will get only 5 marks. Okay. Next. So when it comes to illustration number 2, it's a basic problem. Calculation of FCFF and FCFE. They given sales. You can observe sales less cost less depreciation. You will get EBAT. You will get what, guys? EBAT. On that EBAT, so we are not reducing interest. Already Ganesh asked that question. We are not reducing interest here. Why we are not reducing interest means we are adjusting at the time of FCFF. Why? Because it is a cash in the hands of a company for settlement of debenture holder. That's why in this point we are not reducing. If here you reduces, you have to add back again for settlement at the time of FCFF. That's why don't consider. So EBAT less tax, you will get no PAT. Condition number 1, operating profit or not? Yes, it is an operating profit, EBAT. Condition number 2, after tax or not? Yes, because of reduction of tax, it is an after tax. Next, you have to adjust any non-cash expenses you already deducted. Yes, I deducted depreciation. Add. Next, change in working capital. So I already said, if current asset is increase or positive, reduce. Current asset is decrease or negative, add. Same rule applicable to working capital also. If it is a positive or increasing, less. Working capital decreasing or negative, add. So you can observe the question. So changes in working capital. Changes in net working capital positive 1000. That's why we are reducing. So if you adjust with these two, you will get a CFAT. So after CFAT, you have to reduce capital expenditure. So capital expenditure 10,000. So if you reduce capital expenditure, you will get FCFF. In this FCFF, you have to settle to debenture holder. Interest, don't take direct interest, you have to consider net interest. Net interest means interest 1 minus tax. So next, borrowings. If it is a positive means inflow of borrowing is more, outflow of borrowing is less. Because of inflow, you have to add net borrowings. So you will get FCFE 16,600, 12,250. Here is a chance of getting a MCQ, this kind of question for 4 marks. So they will give that question and they will ask FCFF and FCFE to 2 marks. Hope you guys clear. Next, star problem is not required. Yeah, go and check third problem also. So Whipple Venture Limited has entered the phase of maturity in its life cycle at the cash flows before interest and tax. Before interest and cash flows before interest and tax. Now the expected remain constant at the current level 550.25 lakh. Presently it is an all equity finance firm. So sir, if we are not directing interest, tax will affect. Yes, man. That's why only here we are taking net of interest. Net of interest. Here we are directly reducing the tax. Here, because of not reducing interest, we are losing tax advantage, right? You can observe here. The tax advantage I got here. If I am not reducing tax, I am not accepting the tax advantage. Because of here, net of tax means we are taking advantage only, but not here. We are not taking advantage here. We are taking direct advantage in here. When it's clear, we are not losing the advantage. We are taking the advantage. So the cost of equity of Vedika Limited, which resemble Whipple Venture in terms of risk return characteristic, is 15.75%. So the word 15.75% means KE, 100% equity firm, right? So you are expected to find out the value of Whipple Venture. The tax rate is applicable to Whipple Venture is 38.5%, including surcharge and all cesses. What will be the impact on the firm cost of equity, weighted average cost of capital and valuation if the firm decided to alter the capital structure to have a 25% debt ratio? The cost of debt of the firm with risk portfolio similar to Whipple Venture is 10.25%. Guys, this kind of problems they will framing with a new model. They are framing with a new model. Same this kind of models are they're expecting in exams, guys. If you not understand the question properly, so you will not get the answers. You will not get the answers. Similar questions are they are framing in methods and approaches, in mergers and acquisitions also. Guys, clear? So simple, guys. Understand the theme of the question. So X company initially it is in a 100% equity company. On the time, what is the valuation? Now company changed their capital structure from equity to equity and debt. Equity and debt. What is the value of the firm? So these are the questions they're asking, guys. Okay, simple. If it is a no debt, K is nothing but KO. But if there is a debt, the KO changes. You have to find out the new KO. Now see the solution. You have to understand this concept, guys. Impact of KO, impact of KE as per MM approach. Impact of KE as per MM approach. So you can observe A company, B company. So in A company, 10 lakh, 100% equity, it is a debt plus equity. So 10% debt, guys. So capital employed equals to both the company have same 10 lakhs, 10 lakhs. But the only issue is it is a 100% equity. It is a debt plus equity. Levered firm, unlevered firm. Now EBIT of the company 2 lakhs, 2 lakhs. Interest for a company A, no interest. Why? Because there is a no debt. But when it comes to company B, there is a interest 10% of the capital. Now you will get EBT 2 lakh, 1.5 lakh. Less tax assumption 50%. 1 lakh 0.75 lakh. EASH 1 lakh 0.75 lakh. Now you have to figure out the return on equity. Return on equity equal to EASH divided by capital employed. 1 lakh divided by 10 lakh into 100, 10%. 10%. 1 lakh 0.75 lakh divided by 0.75 lakh divided by only 5 lakh, guys. I am finding only return on equity. Return on equity. That's why EASH divided by equity, not total capital. It is called equity plus debt capital. I want only equity capital. So 0.75 lakh divided by 5 lakh. The answer is 15%. Here is the common sense is involved. So if there is a no risk, investor expectations also less. If there is a no risk, investor expectation also less. So in company A, there is a no debt. That's why there is a no risk. There also the shareholder also not expecting more. But when it come to levered firm, risky firm, why? Because there is a debt. If there is a debt, investor expectation also increases. You can observe there is a no risk 10%. If there is a risk 15%. Yes, as per common sense, if there is a risk, there is a high expectation. Clear? Now we have to prove how this 10% is converted into 15%. How this 10% is converted into 15%. Let us check. That is the process called new KE calculation. I am proving that how this 15% is came. Now if I invest in 1 rupee in levered firm, unlevered firm, I will receive 10%. I will receive what, guys? 10%. I will receive 10%. If same 1 rupee I invested in levered firm, and that levered firm also we have a two capitals. That 1 rupee I am investing in equity plus debt. If I investing in equity, I will receive 10%. The same amount I am investing in debt, I will receive another 10%. Another 10%. And that another 10% I can't enjoy total. On that 10% I have to pay tax. I have to pay tax. What are the amount is pending? I have to pay to debenture holder. So what are the amount I received in levered from 10%? I can't enjoy as a shareholder. At the 10% I have to settle to debenture holder. On the debenture holder also I have a tax advantage. That's why I'm not utilizing entire 10%. I am paying only 5%. 5% is my tax advantage. So 10% minus 5%. This is a 5%. So this is 10%. Total 15%. So this debt equity ratio also very, very important. If debt equity ratio changes, means risk changes. If risk changes, expectation also changes. So this is a formula. This is the formula. The new KE equals to KE of unlevered firm plus KE of unlevered firm minus KD into debt into 1 minus tax divided by equity. Debt into 1 minus tax divided by equity. So this is, if you know this formula, then only we can solve this problem number 3. Guys, clear? Now, estimation of free cash flows of the Whipple venture. Cash flows before interest and tax 550.25. Less interest nil. Why? Because 100% equity. Cash flows before tax 550.25. Less tax rate given in the question 38.5%. That is nothing but 211.85. Free cash flows you will get 338.40. So because of unlevered firm, K is nothing but KO. FCFE divided by R. So FCFE 330.40. R is nothing but K, that is nothing but KO 15.75%. 2148.6 lakh is the value of the firm without capital structure changes. Before capital structure changes. Now calculation of impact on KE if it is a levered firm. Why? Because 25% they are rising through debt. 25% they are rising through debt. Let us calculate. So unlevered firm plus unlevered minus KD. So that is not unlevered from KE plus unlevered from KE minus KD into debt into 1 minus tax divided by equity. So if you calculate this, you will get a new KE that is nothing but 16.88%. 16.88%. Now estimation of weighted average cost of capital. Why? Because because of debt and equity, KE is not equals to KO. You have to figure out. So weights they already given. Debt 0.25 means equity 0.75. So we already calculated new KE. So 0.1688 into weight of equity plus 10.25 they given in the KD rate. It is a pre-tax. Unless they specified, you have to assume it is a pre-tax if the tax rate is given. So 1 minus tax, you will get a post-tax into weight 0.25. So you will get a 14.24 as the 14.24% is the KO. Now value of people limited for as a levered firm. 338.4 divided by 14.2524, you will get a 2376.404 lakhs. So this kind of questions they're asking in every question. So for example, if they give 5A easy, 5B they provide this kind of question. So in every question, subpart A is easy, subpart B is difficult, or sometimes subpart A is difficult, subpart B is easy. So if you observe like that, you can't get 60 marks. Okay, so you have to write at least 6 or 7 questions properly. 6 or 7 questions properly. If you select only one question from every one subpart from every question, you can write only 5 questions. So even though difficult problem, you have to answer. So please focus this kind of questions. Next, so this is a repeating model of question they're asking in the exams. So this is a repeating model of the question they're asking in the exams. Value of the firm calculation. Value of the firm calculation. So you can observe this. Super Shakti Limited is trying to buy Beta India Limited. Is a small biotechnology firm that develops products that are licensed to major pharmaceutical firms. The development costs are expected to be generate. The development costs are expected to generate. The word generate means inflows. Negative cash flow of 10 lakh. So if you invest on that company, first year you are receiving negative cash inflows. So 10 lakh during the first year of the forecast period. Licensing fee is expected to generate second year 5 lakh positive, 10 lakh positive, 15 lakh positive, 20 lakh. Second year, third year, fourth year, fifth year. It means life of the project is 5 years. Next, 2 to 5 years respectively. Due to the emergency of competitive products, the cash flows are expected to grow annually at a modest of 5% after the fifth year. The discount rate of the first 5 years are estimated to be 15% and then drop to 8% behind the fifth year. Calculate the value of the firm. Calculate the value of the firm. Simple, guys. Sakti is a purchaser, Beta is a seller. So Sakti calculating all these values. Sakti calculating all these values. Super Sakti is calculating all these values. So what they're calculating means, if I purchase Beta Limited, so and so money, so and so value, they're not specified the outflow. But they before purchase, they're calculating all those this. What they're calculated means, if I purchase that company, first year I will receive negative, second year I will receive positive, third year, fourth year, fifth year also I receive positive. Apart from that, if I continue with that business in my name, in my organization, under my organization, it will give more money for indefinite life. It means in this problem you have two types of cash inflows. One is forecasted cash inflows. The what is the mean for forecasted? If you know the number of years inflows, that is called forecasted cash inflows. Yes, 5 years I will receive forecasted cash inflow. Up next, terminal, perpetual life, we will receive another cash inflow. For the purpose of perpetual life calculation, I said example 4 and example 5, with growth and without growth, indefinite life. So inflows always two types: forecasted cash inflows, perpetual cash inflows. Combine of this forecasted cash inflow and perpetual cash inflow is known as a value. Guys, clear? Now see, Estimation of present value of forecasted cash inflows. Estimation of present value of forecasted cash inflows. Year 1 to 5, first year negative, second year 5, third year 10, fourth year 25, fifth year 20. So if you multiply with present value factor, you will get a present values. So this 348.04 lakh is not a value. Why? Because this is the value of forecasted cash inflow. You have to calculate perpetual calculation, perpetual value. Now you can observe terminal value is also be known as perpetual value calculation. Expected cash flow divided by R minus G. Why? Because growth rate is specified. Now, so fifth year ending value is the value for beginning value of sixth year. From sixth year to perpetual life, I am calculating. So I always consider estimated or expected, not current year. So 20 is the fifth year ending, sixth year beginning. The word sixth year beginning means current year. I don't want current year. So I want expected or next year. How we convert that current year into next year or expected means if you add growth value, the growth is 5% for long run. 5% if I added, I will get grown cash inflows divided by R minus G, I will get 700 lakhs. So this 700 lakh is a perpetual value. It means a future value. You have to bring this 700 lakhs also present value. For the present value, you have to consider where you calculated. Why? Because indefinite period means we don't know the year. Indefinite period means we don't know the year. That's why where we calculated, that is the base for present value calculation. I calculated this terminal value at the end of the fifth year, beginning of the sixth year. So sixth year beginning, there is no present value factor. That's why I consider fifth year ending. So fifth year ending value is 0.4972. If you multiply, you will get a 348.0.4 lakhs. So the total is 368.2191 lakhs. Guys, anyone have a doubt on these models? Speed up. Do you understand up to here? Discounted cash flow method. Sujit, Ganesh, Harish. Please respond, guys. Okay, then when it come to illustration number 5, following information is given respect of Mind Limited. So I will directly explain what happening in this question. So sales and EBITDA grown at 20% for forecasted life, 8% for perpetual life. So forecasted also growing as well as perpetual also growing. Okay. So don't take it is a first year value. It is a 0 period value. If you want a first year, you have to grown this. You have to grown at 20%. If you take instead of grown value, your answer is wrong. You can observe in year 1 it is not a 7,500, it is a 9,000. How we get this? 7,500 into 1.2, 20% growth, so you will get 9,000. Instead of 9,000, if you take 7,500, you automatically, your problem is wrong. This is a mistaking area in this problem. Next, so this adjustment is very important. During the high growth period, revenue and EBITDA will grow at 20% per annum. I understand this. And capital expenditure net of depreciation will be grown at 15%. Generally, what we do, we will add the depreciation, we will reduce the capital expenditure, right? They're using the word minus depreciation plus capex. Take net value. Take net value. If depreciation is more, you will get a negative answer. If capital expenditure is more, you will get a positive answer. What are the net value you will receive? Into you have to take 15% growth. So instead of less than that, they used only one adjustment. Okay. Next, normal growth period revenue and EBIT will be grown at 8%. This normal growth period is a perpetual life, and incremental capital expenditure will be offset by the depreciation. The word offset means zero. The word offset means zero. When it come to here, net off, the word net off means add or less. The word offset means zero. What are the incremental capital expenditure and depreciation we have, that will be set off each other, you will get a negative answer. That is the meaning of offset. So you can observe capital expenditure minus depreciation into 15% growth every year. Changes in working capital, okay, they are not considered at a terminal value. Why? Because offset. So this is not a value, you have to divide it with r minus g, you will get a value. Next, you have to convert that into present value. So you can observe, so terminal value also they are calculated present value. So this cash flow divided by r minus g into present value factor, you will get a present value. So sum of this 3 years information on terminal value, you will get a total value of the organization. So when it come to illustration number 6, guys, when it come to illustration number 6, another important one, you can check, they give you two types of model, EBITDA information as well as cash flow information. So for why there is a potential value. The clue of the question is potential value. So with help of this discounted cash flow method, you will get one answer. With the help of EBITDA, you will get another answer. Okay. So for the conversion of cash flows into present value, there is a no KO. That's why they provided CAPM information. With the help of CAPM, please calculate KE. With the help of KE and KD and weights, you have to calculate KO. After calculating KO, bring this 100, 120, 150 into present value. You will get one value of the organization. With help of EBITDA into there is a times is mentioned. Yeah. So EBITDA into adjusted EBITDA into 5 times, you will get another valuation. Put a star for that problem. This illustration number 7 and another easy model. So in this illustration number 7, you have a discounted cash flow method as well as a earning capitalization method. You will get a four answers. Out of 4 answer, we have to pick only one. With help of average only, you will get. So what happening means, nothing is new. PAT into grown, CF8 into grown into present value factor, you will get a present values. Total is known as value. But when it comes to capitalization of PAT, so PAT divided by R, CF8 divided by R. The calculation of R is very, very important. The calculation of R is 1 divided by PE ratio. 1 divided by PE ratio. That's it, guys. This all are relating to capital what concept called cash discounted flow method as well as a earning capitalization method. Next, you have to focus on a market value method. Harish is there. Harish, Sujit, Ganesh. So you have any doubts regarding discounted cash flow method, ask me. Why? Because there is a chance of getting problem for this attempt is a discounted cash flow method only. Okay then. So when the next concept is called market approach classification, market price method. In this market price method, there is a concept name called volume weighted average price calculation. Volume weighted average price calculation. So as a final students, you already know the meaning of share market. Share market. Okay. In share market, so what there is a listed companies is there. If you want a listed company share price, just open Google and search that company name. You will get that company information, and that information, it MPS is also available. That MPS is called closing market price per share. Closing market price per share. Here is the issue. So, don't take closing market price per share. Don't take closing market price per share. Why don't take closing market price per share means because of day effect. Because of day effect. The word day effect means, take just an example to understand the day effect. COVID situation. In COVID situation, it is a pandemic. In a pandemic situation, so automatically all company share prices are down. After recovery of pandemic, the prices the share prices are increased without any issues. Share prices are down without any issues. Share prices are increased. Because of that kind of issues, we can't decide closing market price is a valuation principle. Because of that issue, we can't use that closing price is a valuation principle. Okay sir, you can't use. What can you use? I can use volume weighted average price. What is a volume weighted average price means? I will take 10 trading days information. Not I'm focusing on single day, I'm focusing on 10 days trading information. So I will consider turnover numerator, number of shares in a denominator. I will get a volume weighted average price. Comparing to closing price, volume weighted average price give a more valuation, give a more effective and efficient valuation of the MPS. Effective and efficiency of the valuation of MPS. That is the only issue. Now let us check here. So you can observe, this is the Reliance Industries share price. So in every company, they are also maintaining this volume weighted average price. Volume weighted average price. Every share have a opening price and a closing price. Even though it is a closing, even though there is a closing price, investors are using volume weighted average price for valuation principle. Now, how to calculate the volume weighted average price? So volume weighted average price equals to sum of traded turnover divided by sum of shares traded. So turnover means number of shares into closing price. If you multiply these two, you will get a turnover. Sum of all 10 days is known as a sum of traded turnover divided by 10 days number of shares is known as a sum of shares traded. Not only 10 days, based on availability of the information. If you don't have a traded information, there is a no chance of doing valuation. That's why take an assumption closing price is a proxy of volume weighted average price. So closing price is a proxy of volume weighted average price if you don't have any traded information. If you have a traded information, the effective valuation is a volume weighted average price. Let's check the problem. Yeah. So Aditya has been assigned a value of the investment portfolio of ABC Corporation Limited for a financial reporting purpose. The portfolio consists of the following securities. In portfolio, there is a Reliance Industries shares and Mahindra and Mahindra shares. So cost of the share is 2315 in Reliance Industry, 809 in Mahindra and Mahindra. So number of units means number of shares, 1500, 2000. The cost value is 34 lakh 72,500, 16 lakh 18,000. and total value of the investment is 50,90,500. Aditya has collected the share price of information for last 10 trading sessions for the both of the stocks. So they already maintaining at cost. The maintaining of cost is not a proper valuation they're feeling. That's why they're using fair valuation. So what is the fair valuation? Volume weighted average price is the fair valuation. For the purpose of calculating volume weighted average price, they consider 10 days trading information. So this is the 10 days trading information. On the 10 days trading information, this is the Reliance Industry sum of traded turnover. This is the sum of traded shares. This is the Mahindra and Mahindra sum of traded turnover. This is the sum of traded shares. Now you already know the formula. Sum of traded turnover divided by sum of traded shares, you will get a volume weighted average price. So this divided by 27,17,456. This divided by 5,61,449. So fair value per share of Reliance is 2343.76. Mahindra and Mahindra fair value is 824.21. You have to consider this is a market price. What are the market price you consider as a cost basis? That is a wrong version. So 1500 shares into 2343.76. 2000 shares into 824.21. You will get a fair values. Sum of fair value is the valuation of a portfolio. Valuation of portfolio. Hope you guys you understand this market price method. Volume weighted average price. Volume weighted average price. Guys, clear? Volume weighted average price. Good. Next, when it come to illustration number 7, not here also one problem is there. Easy problem, but you have to understand one thing. Calculate the range. Calculate the range. The word range means maximum value, minimum value. It means in this problem you have a two calculation part. One calculation part give one answer, another calculation part give another answer. To comparison, highest value is maximum value, lowest value is minimum value. So this is an important one, but I can't discuss here. It will take only the concept explanation half an hour. That's why I'm skipping this concept. So please learn, solve this also. Very, very important. 5-star related problem. Next. Next concept. Company comparable multiple method. Company comparable multiple method. When it comes to company comparable multiple method, just understand this basic thing, you can easily answer. This is the two companies. This is the two companies. Two companies are doing same business. Pepsi, Camp Cola. So it's a foreign based company. It's Indian based company. Both are doing same production. Both are doing same production. Both are having a same capital structure. It also be equity plus debt. It also be equity plus debt. Equity plus debt. Management style is same. Here also same management style. Same management style. This kind of company is known as similar companies. This kind of companies is known as what, guys? Similar companies. In all aspects, both are same. Just minor differences is there. That minor differences are ignored differences. Okay. So these two are, this kind of companies is known as similar companies. Okay. The issue is with issue is with the Pepsi company. They're not maintained proper books of accounts. Proper books of accounts. If they don't have a proper books of accounts, they can't estimate the future cash inflows. They can't calculate the KO. With help, they can't calculate the earnings. Because of that can't calculation, we can't use a discounted cash flow method. We can't use earning capitalization method. Hope you guys clear. If they maintain proper books of accounts and proper estimations, we can easily use the discounted cash flow method or earning capitalization method. Because of lack of financial information, we can't use the two methods. Even though we can't use two methods, we have to use one method for valuation. That method is called company comparable multiples method. Okay, I can't use discounted cash flow method, I can't use earning capitalization, I can't use net assets valuation, I can't use economic value added. Why? Because there is a no sufficient financial information. And that time what we do means, as a Pepsi company management, they are procuring information from similar company. So that kind of method is known as a company comparable multiple methods. Instead of calculating company information, we are using similar company information for the purpose of valuation. That is called company comparable multiples. Let us check. Total point of view, we are using calculation, as well as per unit point of view also we are using calculation. So first I will explain for only one ratio, remaining all same. You can check. So PE ratio, price earning ratio. You already know how to calculate price earning ratio. Market, in a total point of view, market value of firm divided by earnings of firm. Market value of firm divided by earnings of firm. When it comes to per unit point of view, PE ratio equals to, so instead of ratio, in our textbook they're using a word called multiple. PE ratio equals to MPS divided by EPS. Now here is the issue. Pepsi company need to find out market value of the firm. If you shuffle the formula, you will get an answer. Now market value of firm is nothing but Pepsi equals to, what's the formula? PE ratio into EA/ESH. PE ratio into EA/ESH. Now it is the question mark. We have to figure out. I don't have this PE ratio. I will take from my similar company. That is nothing but a Camp Cola PE ratio. So this is my company EA/ESH. So I have EA/ESH. So this is Pepsi. Now only I consider multiples or ratios from my similar company for the purpose of valuation. That is called company comparable multiples. This ratio is also been known as multiple. Guys, clear? Done. Same like in MPS point of view. Let us check. MPS of Pepsi equals to PE multiple or PE ratio of similar company. What is the similar company? Camp Cola into EPS of valuing company Pepsi. You will get a MPS of Pepsi. Guys, clear? So similarly, we have a multiple concepts called PB ratio. The word PB ratio means MPS divided by PB, book value per share. You can also use in total point of view, market value divided by book value. Next, PS ratio or PS multiple. So MPS divided by selling price per share. That is nothing but market value divided by sales. Next, PC ratio. So MPS divided by cash price per share. Total point of view, market value divided by cash flow. Next, enterprise value to EBITDA ratio. That equivalent to enterprise value divided by EBITDA. So this is a very, very important multiple and ratio out of the all ratios. Now let us check the calculation part. So if you want more information, you can check with this PE multiple, PS multiple, PB multiple, PC multiple, enterprise value to EBITDA multiple. So ratio or multiple give a both meaning. Next, so you can observe the PE multiple, fundamental PE calculation, forward PE calculation, PE multiple based on dividend Gordon's model. This model only, that problem I said important. Yeah. So you can observe the illustration number 13, guys. L Limited is a planning to raise a funds through issue of common stock. Here, L Limited need to value their company, but they don't have a financial information. Because of they don't have a financial information, we are considering a similar company. So for A valuation, we are considering B Limited information, C Limited information, and D Limited information. D Limited information. Now, so with the help of market value on sales, I get a PS ratio. With the help of market value on PAT, I get PE ratio. With the help of market value on book value, I will get PB ratio for B Limited, C Limited, D Limited. If I have only one company similar, I will consider that. If I have a more than one company similarity, I will consider average. First calculate the multiples, ratios. So PS multiple, PB multiple, PE multiple. So with help of this, you have to do average. So you will get average. So instead of single company, you need to take a average for the fair value purpose. Now see, so PS multiple, average multiple, base. Base means our company value. You will get a value. So in a PS multiple, market value equals to PS into sales of A Limited, PS of average. You will get market value of A. So this is a value, this is a value, this is a value. Now they're saying that fair value of A Limited equals to, don't take highest value or lowest value, consider weighted average value. For earnings 50%, pending two values 50%, 50% means 25% and 25%. So 256.75 lakhs. Guys, anyone have a doubt regarding this company comparable multiples? Company comparable multiples, another important concept. Company comparable. Get done. Next. Yeah. Illustration number 4. Yes, Sujit, every model is different model in a workbook. Every model. Only few problems are similar, remaining all are new models. If time permits, I will explain workbook new questions. If the questions are covered in our revision classes, I will said, oh, it's already covered. If it is not covered, I will explain properly. Don't worry about the workbook. Don't worry about the workbook. All new models I will explain. Sure. After completion of revision classes only, I will take that session. It will take only hardly 2 or 3 hours. That's it. Why? Because some problems already included in our material. Few problems are more 40 to 50% problems are not, only 40% problems are not included. Remaining 60% models are already included. That I will give that clarity for that 40% only. Okay. Now let us check this illustration number 14. So this already covered, this already came in our exam. So a valuer has obtained the following information regarding InfoLink Limited. So they have InfoLink Limited information. With the help of InfoLink information, they're asking calculate enterprise value to EBITDA ratio. So you already know enterprise value means market value of equity plus market value of preference shares plus market value of debt plus reserves and surpluses minus cash and cash equivalents. Minus cash and cash equivalents. Why? Because we can't pay their cash to them. That's why we are reducing from cash, we are reducing cash from the market value. Hope you guys clear. So you already know the EBITDA. So EBIT plus depreciation and where you are, don't worry, just calculate EBIT and depreciation and amortization expenses, you will get EBITDA. Guys, clear? Now, number of shares and market price. With the help of these two, you will get equity share capital plus preference share capital plus market value of a debt minus cash and cash equivalents. Next, net profit means PAT. Add interest, you will get PBT. Sorry. Add tax, you will get PBT. Add interest, you will get PBAT. Add depreciation and amortization expenses, you will get EBITDA. Okay. Now, equity share capital, add market value of preference share capital, add market value for debt, less cash and cash equivalents. 1 crore 2 lakhs. Net profit, add tax, EBT, add interest, EBAT, add depreciation and amortization expenses, EBITDA. So case 1, enterprise value to EBITDA multiple, enterprise value divided by EBITDA. So 4.16 times is the ratio or multiple. Now case 2, they're asking E-Link Limited has a represented as a EBITDA of 27 lakh and comparable company to Infolink. So Infolink we calculated. We have to value E-Link. We have to value E-Link. Why? Because E-Link don't have a financial information. So calculate the enterprise value of E-Link. Simple. Enterprise value equals to enterprise value divided by EBITDA ratio into EBITDA. So this ratio is related to Infolink because I don't have. This EBITDA is equal to my company E-Link. So 4.16 times into EBITDA 27 lakhs. So the valuation equals to 1 crore 12 lakhs 32,000. Guys, clear? Guys, clear or not? Okay. So next concept is company comparable transaction method. If I don't have a similar companies, in the market, I focusing on transactions. Focusing on what, guys? Transactions. Let's check this illustration number 15. Simple example as well as problem, both are same. I'm explaining the example as well as problem at a time. So an Indian based startup company created an app like WhatsApp. It's similar like WhatsApp. Guys, clear? But size of the market is different. Why? Because size of the market means if size of the market of WhatsApp 100%, on that with the management and the revenue point of view and every point of view, there are strength is equivalent to 100%. Our Indian startup company strength is equivalent to 5%. Out of that 100%, we are equivalent to only 5%. Because of equivalent of 5%, we can't use a word called similar company. But in India, there is no startups or no companies like that. That's why we can't use company comparable multiple. That's why we're using company comparable transaction. So that's why that the Indian startup company focusing on WhatsApp. In recent time, WhatsApp are valued their company. With help of that valuation, we are using for our company. For example, 1 lakh is equivalent to 100% of the value of the WhatsApp. What my company value? 5%. Na? If you reduce 90%, 95% as a discount, you will get a 5% value of the WhatsApp. The WhatsApp 5% is equivalent to my company. Guys, clear? So sometimes that foreign company is having in a foreign exchange value, you have to convert it into Indian value. If you understand that, you can easily answer this. Monica is trying to value chat app, a chat messaging app that currently has a 16 million users but does not generate any revenues. She has identified that WhatsApp was recently valued at 17.5 billions while having a 450 million users. Consider the difference in the size. Monica believes that size discount of 95%. The size discount is 95% means our equivalent only 5%. Out of 100%, we are equal to only we are similar in the nature of 5% only. So foreign exchange rate 65 per USD. First calculate the value per user. Enterprise value 17.5 billion divided by number of users. You will get value per active user. If you multiply with exchange rate, you will get Indian value per user. Out of Indian value per user, you have to reduce 95% discount. You will get a 5% value that equivalent to 126.39 per user. So that our Indian company have a 16 million users. If you multiply that, you will get a value of the chart app. Guys, clear? This question also asked in our exam. Next. So the next concept net assets valuation. Net assets valuation. So the word net assets valuation, the net asset is also have an alternative name. Equity is also be known as proprietary fund, is also be known as owner fund, is also be known as fair value, not fair value, intrinsic value. So these are the alternative names we have. For net assets calculation, we are using two types: liability side calculation, asset side calculation. In liability side calculation, equity share capital plus reserves and surpluses plus preference share capital minus fictitious assets. This is the liability side calculation. When it comes to asset side calculation, total assets minus external liability, minus fictitious assets, if any. Total assets means we are taking at the end value, right? That end value includes fictitious assets. If not included, ignore. If it is included, less fictitious assets, then you will get a net total assets. Out of net total assets minus external liabilities. The word external liability means long-term debt plus current liability. So this is the ways we have to calculate net assets, guys. If you use this, you will get a direct answer. At least it will be either one or two lines answer. That's why don't use this for this net assets valuation calculation. You can use, no issue, you will get the same answer, but the issue is the presentation look like a 3 to 4 lines. For 3 to 4 lines, there some valuationers are not consider not give 7 marks. That's why don't do this presentation. Go with this one: total assets minus if any fictitious assets reduce, you will get a net total assets. On net total assets, you have to reduce external liability, you will get a net assets. Guys, clear? But in our problems, they will give book values as well as fair values. So case 1 they will ask book value, case 2 they will ask fair value. So at the time of fair value valuation, they are following simple trick: total assets minus external liability given in the books, you will get a net worth or net assets. For this, if you want, this is called book value of net assets. For this, you have to reduce what are the fair values given in the adjustment. You have to what are the fair values they given, you have to consider book value of that assets, you have to reduce. For example, book value of PPE minus book value of investment. So this have a fair values. This already included in this now. That's why I'm reducing. Instead of this to add fair value of PPE, add fair value of investment. You will get a fair value of net assets. For all problems, this only happening. Guys, clear? Now see, I will give a clarity in one problem. You can go and check another ones. Yeah. So the company records PPE and investment at cost. The property, plant and equipment contains land 220.70 in the books. Based on the assessment, the land value has appreciated by 15% from the book value. So the increment of 15% is known as fair value. Investment include 40,000 shares. Reliance Industries 10,000 shares. Infosys as a valuation date, they are trading at 2,300 and 1,800. So the number of shares outstanding is 2,64,400. So first you have to figure out book value of the company. So I already said book value of the company, liability side point of view. Equity share capital 26.44 plus other equity is nothing but reserves and surpluses 608.07. There is a no what? So there is a no, sorry guys, I think this question is mistake. I think long-term debt value is not 608.07. You have to adjust this. Wait a minute. Just a clerical mistake, guys. Okay, you can check, no issue. So first I am finding book value. So 634.51. Okay. Now this 634.51 is a book value of a net worth. I don't want to book value of a net worth. I want a fair value. So for fair value purpose, I have to calculate fair value. The PPE total value is 441.39. Out of 441.39, PPE is a 220 point, land value is 220.70. The pending is remaining PPE. So out of 441.39, land value is 220.7. The pending is 220.7 only. Now this pending value not increased or decreased, but this 220.7 increased by 15%. It means 253.80. The fair value means 253.80 plus 220.70. The total fair value is 474.5. 474.5. This is called book value. So I am reducing this book value. I am adding this fair value. So see here, book value 441.39. Add fair value 474.5. Next, investment calculation. 40,000 into 2,300, 10,000 into 1,800. The answer is 1,100. But in books of accounts, you recorded only 1,000. This 1,000 is a book value. This 1,100 is a fair value. So less the book value, add the fair value. So you will get a net assets of fair value 767.62. They given a number of shares also in the question, 2,64,000. If you divided with the shares, you will get a value per share. Guys, clear? Guys, clear? If you understand the subject, you can do anyways, guys. All are give a same answer. Liability side calculation also give a same answer. Asset side valuation also give a same answer. So if okay with this concept, I want to explain another concept called exchange ratio. Exchange ratio. So the word exchange ratio means at the time of merger or acquisition. At the time of merger or acquisition. After this, I will explain mergers and acquisition chapter only, guys. Tomorrow, mergers and acquisition only. Tomorrow, mergers and acquisition. So exchange ratio. So it is an important calculation part in mergers and acquisition. It's a very important calculation part in mergers and acquisition. So exchange ratio means at the time of purchase or sale of the company, how many shares purchaser will give to selling company on the occasion of merger or acquisition. Calculation is known as exchange ratio. Simple. At the time of sale or purchase, how many shares will give purchaser to seller on the occasion of merger or acquisition is known as exchange ratio. So acquiree values divided by acquirer values. Acquiree values divided by acquirer. The word acquiree means seller. The word acquirer means purchaser. The word acquiree means seller. The word acquirer means purchaser. Seller values divided by seller values divided by purchaser value. What are the values? Either MPS of selling company divided by MPS of purchase company, or either MPS of seller company divided by EPS of seller company divided by EPS of purchaser company, or book value per share of seller company divided by book value per share of purchaser company. Sir, how I get this book value per share? Book value is nothing but net worth divided by number of shares. You will get book value per share. Guys, clear? Okay, done. So this is the concept of exchange ratio. This exchange ratio is also been known as swap ratio. Done. Now see this problem. They're asking a question. Using the above information, what should be the share exchange ratio to be offered to the shareholders of Blooming Company Limited by Blooming Company Limited based on book value per share point of view, based on earning per share point of view, based on market price per share point of view? I think market price directly given in the question. So first you need to focus which company is a selling company, which company is a purchaser company. This is a selling company, this is the purchasing company. Now MPS point of view, swap 40 divided by 45, so 0.88, 0.889. The meaning of 0.889, listen carefully, the meaning of 0.889 equal to, for every one share of selling company will receive, for every one share of selling company will receive 0.88 shares from purchaser. For every one share of selling company will receive 0.88 shares from purchaser. That is the meaning of 0.88. 0.88. Next EPS point of view. So PAT is given guys. If PAT is given, if there is a no preference share capital, means PAT is nothing but EAESH. PAT is nothing but EAESH. Now, I think there is a no preference share capital in the balance sheet. That's why PAT is nothing but EAESH. Divided by number of shares, I will get EPS. See, PAT is nothing but EAESH divided by number of shares, I will get EPS. 11.86, 11. Now 11 divided by 11.86. The answer is 0.92748. So the word 0.9277 means for every one share of Blooming Company Limited will receive 0.927 shares from Blooming Company. Hope you guys clear. Next, BPS calculation. I said already, net worth. So equity plus preference share capital, thing there is no preference share capital, plus other equity is nothing but reserves on surpluses minus fictitious assets. There is no fictitious assets. That's why equity share capital and reserves on surplus is nothing but net worth. Divided by number of shares, you will get book value per share 29, 22.29. Swap 22.29 divided by 29. So 0.7685. So the meaning of 0.7685, selling every one share of selling company will receive 0.7685 shares. So in company's point of view, for every one share of Gloomy Company Limited will receive 0.7685 shares from Blooming Company Limited. Blooming Company Limited. Hope you guys clear. So these are the models we have. So Ratnakar Limited model also there. I will give an overview. Last it also be important one. So you have to calculate a net assets value method and earning capitalization method and swap. So there is a two companies is there. In net assets point of view, two companies have a two market prices. In earning capitalization point of view, also two company have a two market prices. But swap purpose, I want only one market price of each company. But every company have a two market prices. For that, they provided weights 1 and 3. 1 and 3. Now net assets point of view, total assets minus external liability divided by number of shares. So same, total assets minus external liability. I think there is a no external liability divided by number of shares. Earning capitalization point of view, first you have to get a value with the help of R. Earnings divided by R, you will get a value. Again divided with the number of shares, you will get a earning per share. So 850 divided by 8%, you will get a value. Divided by 3.5 shares, you will get a value per share. So 10 divided by 8%, you will get a value. Divided by number of shares, you will get a value per share. Now Ratnakar have a two values, and JVSB also have a two values. I don't want two values, I want a single value. Now you can observe Ratnakar Limited net assets into 1 is the weight, earning capitalization into 3 is the weight, divided by total weight 4. You will get a fair value of Ratnakar Limited. 480.46 into 1 is the weight, net assets, JSB Limited point of view. 192.31 into 3 is the weight, divided by total weight 4. You will get 156.3475. Now these are the fair values. Now selling company fair value divided by purchasing company fair value, you will get exchange ratio 0.1787. For every one share of Glomi will receive Glomi will receive 0.1787 shares from, sorry, for every one share of JSB Limited will receive 0.1787 shares from Ratnakar Limited. So these are the models we have, guys. So these are the models and methods we have. That's it. Valuation of methods and approaches revision. If you have any doubts, ask me now. If you don't have any doubts, I will close my session. We will meet next class. The next class is mergers and acquisitions. From tomorrow onwards, I will use for only two classes it's pending. For tomorrow onwards, I will add that workbook. I think newly issued the workbook. I will add that problems also I will explain. So remaining pending chapter problems, I will conduct a session after the revision. For mergers and acquisition, assets and valuation, I will explain this model and concepts and that workbook problems also. For which model come from exams or guess? I think discounted cash flow method, net assets valuation method. Discounted cash flow method and net assets valuation method. Next. Okay then. Thank you. Bye. Good night.